Hi everyone, welcome once again to Kotak Securities Weekly Fundamental Podcast. I am Tini Mehta. The markets remained sluggish throughout the last week as the rate hikes and inflationary pressures continued to be a major drag. Theoretically, if we see, demand side issues are tackled by the central bank through monetary policies, while the supply side ones are via the government's fiscal measures. However, in the real world, when there is a crisis, its cascading effects are felt across borders, sectors, and segments, and more often than not, a combination of fiscal and monetary policies are implemented. So, guys, Nifty index declined around 7% over the past week. Markets reacted to increased risks of a global recession as the US Fed was forced to raise interest rates by 75 basis points due to persistently elevated inflation. All sectors ended in loss, with metals losing the most. Within the Nifty index, Hindalco, Tech Mahindra and Tata Steel lost the most, while Divi's Lab, Britannia and Nestle gained the most. Now on the economy front, headline CPI inflation, that is retail inflation in May, dropped to 7.04% compared to 7.79% in April, while April IIP registered a growth of 7.1% year on year, which was 1.8% in March. Then FPI outflows stood at $2 billion over the past 5 trading sessions, while DIIs, that is domestic institutions, bought $1.75 billion over the same period. Now oil prices edged slightly lower by weekend as worries about global economic growth and uncertainty weighed on markets following numerous interest rate hikes around the world last week, which I'll also talk about it in a bit. Brent crude fell 0.8% to $118.98 a barrel. So coming back to the global news, the Federal Reserve on Wednesday increased its benchmark funds rate by 75 basis points, as I said, which was the largest hike since 1994, with US inflation running at a 40-year high of 8.6% in May. The Swiss National Bank then surprised markets with its first rate hike for 15 years on Thursday, while the Bank of England implemented its 5th consecutive hike. The European Central Bank announced following an emergency meeting on Wednesday that it plans to create a new tool to tackle the risk of Eurozone fragmentation, a move that is aimed at assuaging fears of a fresh debt crisis for the common currency bloc. In other international news, the European Union could be about to throw its support behind Ukraine, becoming its newest member, but the process will not be easy. Coming back to the FPI flows, month till date FIIs are net sellers to the tune of rupees 42,088 crores, mainly on account of rising inflation, tight monetary policy by global central banks, and elevated crude oil prices. But we also expect FPI flows to remain volatile in the emerging markets on account of rising geopolitical risk and other reasons that I mentioned earlier. Moving on to the top stock picks, our pick of the week is Oil India. We have recently upgraded rating to add. Oil's fourth quarter results were above our estimates as lower than anticipated oil realizations and gas sales volumes were offset by a decline in employee and other expenses and a sharp decline in depreciation and amortization costs. We sharply raise our FY 23-24 earnings estimates on factoring higher oil and gas price assumptions. We upgraded oil to add with a fair value of rupees 285, given elevated oil prices will sustain for longer, driven by unyielding geopolitical issues, a tight supply situation and declining global inventories. Lastly, we have Sun TV. We have upgraded the stock to buy with a target of rupees 540. At current market price of 410, the stock is trading at 3 times FY22 core TV business earnings, which is excluding other income. Assuming valuation of rupees 75 billion of IPL team and excluding cash balance of rupees 45 billion. Stock offers value even after factoring structural risks. Company's underlying cash generation remains solid. We take a leap of faith that the management would increase dividend payout addressing capital allocation concerns. So guys, that's all for today. See you again next week. Signing off. Thank you.